Hey everyone, welcome to another breakout session. Most of you I see in the chat have been doing this. I imagine you're early stage founders looking for, great organization to connect with and who are the best people for assisting an early climate founder. And that's why we like putting these together. And I'm excited to introduce Sarah Kearney, who is the founder and executive director at Prime Coalition. We haven't had them have a breakout session before, so I'm really excited to have Sarah here. For some of the ground rules, everyone. So you see the chat. I've pinned the welcome everyone. Where are you joining from? Tell us where you're joining from. Tell us what you're up to. What are you doing? What are you working on? Are you an investor? Are you a founder? Are you doing cool things? Are you looking? Are you seeking to join the climate transition revolution? All of that. And then you'll see next to that people, so you can see who's here. Then you can see the Q&A, and in the Q&A is where you will ask your questions, okay? And then upvote the ones you like. That way, Sarah can easily find all of your questions and sort through them, okay? So we want to make it as easy as possible. For now, Sarah, we'd love to hear about Prime Coalition and as many words as you'd like. I'm going to hop off, but if there's any issues, just let me know.
Thank you so much. This is so fun. As Stefan said, my name is Sarah Kearney. I'm joining you all on video from my home office. I live outside of Boston, Massachusetts in the US. I founded Prime back in 2014 based on my own experience having run a private family foundation called the Chisonis Family Foundation and gotten religion about the right resources to fuel our innovation economy, particularly around our dire climate challenge. And based on what I learned from the Chisonis Family Foundation, where I served both on the grant-making side and as a trustee on the endowment, I went back to graduate school back in 2010 to ask a very specific research question, which was, are there better financial vehicles for families that see for-profit investing as an important tool in their toolbox to achieve their charitable goals? And it was in between 2010 and 2012 while I was working with a brilliant MIT professor named Fiona Murray, who sent me to a law library just to read the US tax code, that I remember the day I read a section of the US tax code about program-related investments, which is a tool that have been available to US-based private foundations since 1969, but had never been applied in the way that I was interested in, which is for science and engineering innovation that is critical to a specific charitable purpose, but might be difficult for our existing financial system to support. And so I started Prime, which originally stood for Program-Related Investment Makers of Energy, to try to bring down the very high barriers that make this style of what we now call catalytic investing prohibitively difficult for any one philanthropic asset owner. No matter how much money you have or how much staff you have, you have to make a very strong case that the charitable capital that you are marshaling, if you want to put it into a market-driven solution, which is a for-profit company, project, or fund, you not only have to argue that the primary purpose of your investment is charitable, but also you have to make a strong counterfactual argument. Prime calls that additionality, but you have to make the strongest case possible that that investment would not be made but for the charitable purpose. So when I first read this language back in 2010, this tool had primarily been used for low interest debt for affordable housing in the US. And my graduate work proposed its use for venture capital style investing for tough tech, as the engine calls it, or areas of science and engineering innovation that are important and need long-term support from dollars at a meaningful scale to cross what some call the valleys of death, either at the earliest stages of company formation or later on for first of a kind projects. We really formed Prime as a public charity to focus on what is challenging for philanthropists. And so we formed ourselves as a public charity in 2014. And since then, Prime has run what I think of as 3 large-scale experiments just to try to get some early proof of concept investments going, because very, very few philanthropists had used these catalytic capital mechanisms in any area of science and engineering innovation before we got started. And so to start, Prime funded 1 company at a time. We did that, we call that our syndication phase, and that ran from 2015 to 2018. And we supported 10 companies that way. And we worked with 54 different philanthropic investors, and we mobilized around $25 million. We then had enough momentum from our amazing community of philanthropists to move on to our second experiment, which is called Prime Impact Fund. And this is a 100% catalytic fund that we didn't know if we could kind of in a blind pool raise this type of catalytic capital, impact first capital from charitable sources to the fund's minimum size of 20 million, but ultimately we closed at a $52 million seed fund. Some of you may have encountered the amazing investment team from Prime Impact Fund. And then just recently we announced that we moved on to our third big experiment, which is called Azola Ventures. And the experiment question now is, if we put a pool of catalytic capital under the same fund thesis alongside non-charitable capital, can our investment managers stay involved even longer into each portfolio company's life so that we can continue to be there for our founders and as a voice that is intrinsically motivated to point the company in the direction of the highest impact trajectory. And so across all 3 of those phases so far, our investment criteria has been the same. So we target a very high climate impact threshold. Our target is 0.5 gigaton of CO2 equivalent emissions reduction potential by 2050 cumulatively for each company that we're looking at. The second we call bridge to somewhere. Does each company have a commercial pathway where we can imagine that impact happening at large scale? And then lastly, additionality. What are the reasons that the company might be challenged to raise sufficient financial support without us? And so those 3 investment criteria have stayed the same across our syndication phase, Prime Impact Fund, and Azola Ventures. And with the final close of Azola Ventures, that marked the end of Prime's original 10-year strategic plan. We had worked with about 250 different philanthropic organizations. We have learned an incredible amount about both the mechanisms for how philanthropists can participate in programs like this and how to put guardrails around the intermediation function itself. And so as we look forward to the next 10 years, we are very excited to try to start to work with multiple investment teams. Our ambition is that we will have 4 investment teams actively working on building and implementing investment programs by 2033. And so Azola Ventures is actively investing now. Our second investment team that we're in the design phase for now is called Early Climate Infrastructure. That's a team that's being led by Dr. Laura Pierpoint based in Oakland, California. Where Azola focuses on the earliest stages of company formation, our ECI, Early Climate Infrastructure Program, focuses on late stage demos and first of a kind projects that would struggle to raise sufficient financial support without our intervention. The last thing I'll say is that everything I've talked about so far falls under our steering capital strategy at Prime. We also have a number of kind of mission critical influencing capital strategies that we think kind of bring useful resources to investors outside of our own programs. And so we have a big community called Project Frame. It has over 1,000 members. primarily investment managers that come together around consensus technical standards for how you do the assessment of forward-looking emissions reduction potential. All are welcome there if you want to check it out, Project Frame. And then we also have developed an online free open source tool called Crane at cranetool.org that helps companies and investors do forward-looking emissions reduction assessment, either during your diligence or after you've made an investment. If you want to track how a company or technology is doing against your targets, the Crane tool can be helpful with that. And then lastly, and then I'm going to get to everybody's questions, because we have now worked with over 300 philanthropists, and we've mobilized just over $300 million of catalytic capital, and people know that we've launched these steering capital programs. I'm approached very frequently by others saying, I want to be the prime of, and they either mean, prime of Canada or prime of pediatric medical devices. So we are thinking long and hard right now about the right format for sharing our own lessons learned so that others can build programs that also aggregate and deploy this really important kind of color of capital in the context of our innovation economy. So with that, I'll see if I can go over to the chat. I'll just go, maybe I'll go to popular, see if what y'all are upvoting. The one at the top of the popular questions comes from Juan Pedro Corica. Thank you so much for your question. If the speed of climate tech solutions adoption is one of the problems for a more sustainable present, what do you see on the innovation front to tackle this issue that is most promising? So we need both speed and scale. And what we've seen is that there's all kinds of choices that entrepreneurs have to make about development pathways and parallel development pathways in order to reach their figures of merit in their particular solutions industry and what their customers are looking for. A friction point, which is what Prime as a nonprofit is most interested in, so capital gap, that we have observed and now substantiated is something that is holding back both speed and scale of the deployment of large-scale climate solutions is this first-of-a-kind project gap. And this is where a company, maybe you've raised your seed, Series A, Series B, you've got a widget that you have built at either lab scale or demo scale, and it comes time to build your first commercial scale facility. And it is both very difficult to fund that with traditional venture capital, and traditional project finance cannot take on any type of technical risk. And so it's extremely difficult to raise the type of project financing that you might need to build a commercial facility. And so there's this missing middle. And our hypothesis is that catalytic capital has an important role to play in that missing middle. It remains to be seen, kind of based on our learning by doing. We're in a design phase ourselves where we have a lot of market research questions. And I say market research about philanthropists, whether we can aggregate a meaningful amount of catalytic capital to step into that missing middle for first-of-a-kind project finance. So that's the gap that we're focused on right now when it comes to speed and scale of climate tech solution adoption. I'm going to go on to the next popular question. Can you put your contact info here? I think that I am technically capable of doing that. Let me see if I can do that after I answer a few more questions. The next one comes from Darren Lang. Which primary emissions use case, ag, commercial and residential, industry, transportation, do you think needs more attention from startups? Which, if any, is oversaturated? Great question. I'll start by saying that my organization, Prime, is industry agnostic. And so we are interested in hearing from either startups within our venture capital program or projects within our project finance practice in any industry that holds promise for large-scale emissions reduction. In order to clear the threshold of our investment criteria, which again is very high emissions reduction potential, path to commercial scale, and additionality, I do find that hardware or solutions that have a hardware component tends to be the best fit for us, because that tends to be the most kind of arduous to finance type of solution. And so for us, because of our third investment criteria, additionality, you can see on our website, primecoalition.org, both in our venture portfolio and soon our project finance portfolio, we are supporting a whole wide range of solutions, but all of them tend to hurt when you drop something on your foot. Let's see, I'm going to go to Rohit Vedara's question. With such a high bar on CO2 impact, do you feel that some companies just 10x the market size and assume that they are the only people in town? To answer this question, because I think what you're doing is questioning the hockey stick graphs of entrepreneurs that they might present in their own pitch decks. Of course, I have a healthy skepticism about that. And I will also say that I am inspired by the optimism of entrepreneurs, myself as an entrepreneur and founder myself. And so I think what's important to say about Prime is that we have come up with a really well-governed diligence process where we have an investment management team that is doing deep technical diligence on all of the questions that traditional venture capital firms normally look at, team, go-to-market strategy, figures of merit and technical claims, IP, et cetera. And one privilege that we have at Prime is that we also have a full nonprofit team where it's our impact team that does the deep diligence on both impact potential and additionality before our investment team can proceed with making any investment decision. The last thing I'll say from a governance standpoint is we have a mission alignment committee of kind of third-party experts that have to approve each impact diligence packet and additionality diligence packet before the investment team is able to proceed with an investment. So I think this gets kind of to your question about a healthy skepticism of claims that entrepreneurs are making. From where I sit as executive director of the nonprofit and the founder of our investment programs, what's really important to me is that we have excellent governance and checks and balances to make sure that the people that are making investment decisions and that are incentivized by carried interest are not also the same ones that are putting their thumb on the scale and approving that specific investments might be clearing an impact threshold or an additionality threshold. There's kind of separation of church and state. All right, I'm going to move on to Fabio's question. How has the prevailing investment scenario influenced your company's metrics requirements, especially for climate-focused firms integrating both hardware and software, hence capital intensive? This is such a good question. I feel like this is the question. For us, additionality is a point in time assessment, and it is totally determined by the ebb and flow of what other investors are doing. So when I founded Prime back in 2014, the tide was all the way out on traditional venture capital into anything that we would now call climate tech. In fact, in 2015, Thomson Reuters used to have a clean tech flag on anything that could be construed as a clean tech investment, and they reported $0 of initial investment from the venture capital community as initial investment into anything flagged as clean tech in Q2, Q3, and Q4 of that year, just to give you a sense of how dire it was. And so the additionality argument for us as we deployed catalytic capital was very kind of straightforward and binary, because if you looked at the whole universe of all climate tech startups, there were so few that had any chance of raising traditional venture capital. Now, we've both learned about the power of our presence in investment rounds. And so our own kind of viewpoint on additionality has become more sophisticated. And to your question, Fabio, as the tide has come back in and there are more firms and more capital flowing into climate tech startups, first of all, it's the most joyful thing that I could imagine for my firm, because it's both follow-on investors into our portfolio. It also means that that whole universe of climate tech startups doesn't need our type of support. So it's a very joyful evolution, but it's one that we have the onus to assess in real time in order to have fidelity to our nonprofit mission, which is to have not only compliance around additionality, but also strong conviction among our staff that we're using this very precious charitable capital toward its highest and best use. So I hope that starts to answer your question. If you're very curious to dig into this topic of additionality, Prime has an online resources library where we share a lot of our legal documents and lessons learned about catalytic investing. And we have a working kind of internal paper about our own definition of additionality that goes into exactly how we assess this, both during the substantiation of any launch of a new fund, and then also on a company by company basis within the context of a fund that is actively investing. So I think you're asking the right question, and it's one that is always very, very tricky. In fact, I think it's prohibitively difficult for like single asset owners in the absence of surveying the investment community around them, which is a very labor intensive process. Okay, I'm going to go to Scott Stanford.
Oh, perfect. I was just actually going to say, because I think you were on latest, but now you're unpopular, I think. And Scott and Agneta looked like they were pretty popular questions. So just wanted to flag those. But
okay, great. Thank you. Maybe should those be the last two? Or
No. Well, depend. No. You definitely have time. No worries.
Are we going? Am I going too fast, too slow?
No, you are doing a fantastic job. Couldn't ask for anything better.
Well, these questions are great. Scott, you ask, can you give examples of the types of companies that meet or don't meet your third funding criteria of additionality? Oh, I love this question. Which companies may or may not be challenged to raise support without you? Rather than talking about specific companies, I think what I'll describe to you is the process that we go through. And as I said before, it's our nonprofit team that holds the responsibility of conducting this assessment. And it's on every company that our investment team flags as kind of getting near the end of their diligence process. And so we do additionality assessments on many, many more companies than our programs ultimately invest in. And our additionality assessment includes 3 sections. The first section is just secondary data, how many venture investments have been made in this specific industry in the last 5 to 10 years. So it's kind of data crunching. The second section is all about live feedback from other active investors in that industry. So we have this incredible volunteer investment advisory committee, and you can look on Prime's website and see the photos of those incredible people. I will say convening that committee has been one of the most joyful parts of working at Prime. It's an incredible group of people whose time is very valuable, and they generously donate their time to Prime for this purpose. And we ask them to come together around 2 very complex topics. The first is advisory, and we're asking them, if this company makes it to a certain milestone, would you be interested to invest? And so that's advisory to the investment team on their assessment of commercial potential. The second part of their assessment is gating, and it's part of the additionality assessment that I'm describing. It's the second of 3 sections in our additionality assessment. And the question is, what are the reasons that you and your firm might struggle to invest in this company right now? We have a rubric that we've developed over time of all different types of reasons. The technology development timeline is too long for my 10-year closed-ended fund, or this company is operating in an industry that has a lot of, ghosts in its failed exit graveyard, or there's a regulatory risk that would need to be retired. So we try to be very, very specific about exactly what would prevent those firms from investing. And then it's our job to decide if those reasons are surmountable or insurmountable with our style and scale of capital. It's the difference between a quote unquote bad investment and a good investment that would otherwise struggle to raise sufficient financial support. So that's section 2 of 3. The third section in the additionality assessment is around the circumstances of the round. And more often than not, this has become a more compelling part of the additionality assessment over time. And again, this goes back to our observation of the power of catalytic capital in the context of bringing together a healthy syndicate of investors around a company and having voice to support entrepreneurs so early in their journey, and really become a part of their team is just invaluable at the early moment when catalytic capital can participate. I think that we have 1 minute left, so maybe I'll get to Agnetta's question. What geographies are you investing in? So historically, our first 3 investment programs, Syndication, Prime Impact Fund, and Azola Fund 1, are exclusively focused on US-based companies, except by exception. I think Azola Fund 1 now has 2 companies that are based outside the domestic US. And that is not for any reason except that we have found there's no shortage of companies that are both needy and deserving of our support in the US. I think our model would be important to bring to many, many other geographies. And that's something that we're thinking about as we look forward to our next 10 years and thinking about which kind of teams we want to get going in different verticals, other capital gaps that are also dire in the face of our planet being on fire. So we're just going to do as much as we can. And we have a deep appreciation for both the giving culture and the money inside among charitable asset owners in other places outside the US, and the opportunities to support innovators outside the US. It's just a business strategy choice that we've made so far to make sure that we are able to get to those that we're supporting. I think we're at time. Stefan, should I say goodbye to everybody that I can't see? Thank you for joining my session. I hope this was interesting. And
well, if there's one more, I think there might secretly be like a sound issue with the next session. So if you want to answer one more.
Okay, great.
You saw that was amazing. And then I'll do like a little outro and a little bit of how do they find you type of thing, you know?
Oh, this is such a good question. I see from Nikhil Bambi. What is the, I'm so sorry. I'm sure that I've mispronounced everybody's names. What is the difference in investment criteria between Prime Impact and Azola Ventures? This is such a great question. The investment criteria are exactly the same. What is different between Prime Impact Fund and Azola Fund 1 is that Azola has a non-charitable sleeve, so that its investment managers, once a company graduates from Additionality, can make the choice of whether to continue to invest if that company remains on the same impact trajectory that Prime cares about. So in Prime Impact Fund, once a company graduates from Additionality, we no longer can invest because the whole pool is catalytic capital. In Azola, we have a pool of catalytic capital and a pool of non-charitable capital. We call it full cycle capital. and they co-invest in a 1-to-1 pre-wired ratio in the earliest rounds where we have established additionality. And you can continue to co-invest in a 1-to-1 ratio in any follow-on round where additionality has been established. But once a company graduates, the catalytic sleeve behaves just like Prime Impact Fund, but the full cycle sleeve can continue to invest selectively if the company is still on that high climate impact trajectory. So the investment criteria are the same. It's very high emissions reduction potential, commercial potential, so we call it bridge to somewhere, and additionality. Those are the 3 investment criteria for both Prime Impact Fund and Azola Fund 1.
That was fantastic. Yeah, right.
That's
I think it was great. I think it was, yeah, that was amazing.
I can't see anybody, but have a wonderful rest of your day, everyone.
They can all. I mean, I think there were like over 300 people enjoying this session. So I think you did a great job. Thank you, everyone, for joining. And more importantly, thank you, Sarah, for hosting. We're so happy to have had you here. How do they find you?
Oh, I'll put my email address in the chat, and
great idea.
Actually, let me think about all the different email addresses I can put in the chat. First, I'll put pipeline at azolaventures.com. That's one, and then you know what? I'm going to do my own is here. Here we go. And maybe I'll do Prime strategic plan if you're, or maybe I'll do Prime's resources library. I'll put that in the chat.
That's a good one too.
That's our resources landing if you're interested to learn more about the mechanics of catalytic capital. And now I'll put some more in the chat. I'll do our strategic plan just so you can see more about what we are planning to do over the next 10 years if you're feeling fired up about Prime Coalition.
This was amazing. Yeah, thank you so much. Hopefully we can have you do another thing soon. And where are you based again? You're in
I'm based outside Boston. Prime headquarters is in Central Square, Cambridge, Massachusetts. So let me know if anybody's ever coming through.
Oh, we'll have to soon. This has been fantastic. Thank you again. Everyone will have more sessions. There's one starting right now, so I'll see you over there. And then Sarah, thank you again. And everyone, follow, email, do all the things.
My pleasure. Thanks for having me. Take care, everyone.
Take care.